People always say money is confusing, but today, we're going to break down one of the most important decisions you'll ever make in your wealth-building journey: the choice between index funds and individual stocks. This single choice can be the difference between slowly building wealth or actually becoming rich over time. And before you decide too quickly, there's something surprising about this topic that most people never realize. That's why watching until the end is so important. Your entire investment strategy might change after this. Let's start with a question that might already be in your mind. Why do some people swear by index funds and talk about them like they're magical, while others claim the only real way to get rich is by picking individual stocks like Apple, Tesla, Amazon, or whatever the next big thing is? They both sound convincing. They both sound smart. But they can't both be right. Or can they? You and I are going to walk through this in the simplest way possible. No confusing words, no complicated charts, just the truth about what really builds wealth and what actually works for normal people who want to grow their money without losing sleep every night. First, think about what most people want: more money, less stress, fewer risks. But at the same time, everyone loves the idea of hitting it big. And that's why this is such a tough choice. Index funds feel slow but safe. Individual stocks feel exciting and full of opportunity. Which one is the real path to becoming rich? Before we go deep, I want you to think about something and tell me in the comments. If you had $10,000 right now, would you rather invest it into a single fast-growing company, or would you spread it across the whole market? Drop your answer below because I want to see how many of you are risk takers and how many are long-term builders. Now let's talk about index funds in the simplest possible way. An index fund is basically a giant basket of many different stocks. Instead of choosing just one company, you get tiny pieces of hundreds or even thousands of them. If one goes down, others can help balance it out. It's like betting on the entire economy rather than a single business. This is the reason so many experts say index funds are the easiest way to build long-term wealth. They grow with the market. The market might rise slowly, but over decades it has almost always gone up. And the best part? You don't need to be a genius to invest in them. You don't need to read financial reports every morning. You don't need to watch the stock market like a hawk. You just buy and hold. But here's something most people never tell you. Index funds don't make you rich quickly. They make you rich eventually. And the word eventually scares people. Many want fast results. They want that one big win that changes everything. That's why individual stocks are so tempting. Let's talk about those individual stocks, the ones everyone loves to argue about. Apple, Tesla, Microsoft, Nvidia, Amazon. When these companies grow, their stock prices can explode. And people who invested early made life-changing money. Thousands turned into millions. Millions turned into tens of millions. And that's exactly why people think picking stocks is the true path to wealth. But here's the hidden side. For every person who chose the right stock, there are millions who chose the wrong one. Companies fail all the time. A business can look unstoppable one year and fall apart the next. Picking the right stock isn't just about research, it's about luck. And most people don't want to admit how big the luck factor is. So here's the big question. Do you want predictable, steady growth, or do you want the chance at a huge win, knowing there's also a chance of a huge loss? Which one feels right for your personality? If you're still here, you're already doing better than most people who invest without ever understanding what they're doing. And right now, I want to ask you something else. Would you rather have slow, safe growth over 20 years, or risky, unpredictable growth that could go very well or very badly? Leave your answer in the comments so I can see how you think about risk. Now let's dive deeper into what actually makes someone rich. Most people think getting rich is about finding the best investment. But that's only part of the truth. You become rich by doing something consistently for a long time. You become rich by staying invested. You become rich by avoiding big mistakes. And most people lose money not because the market is bad, but because they jump around too much, chase trends, panic sell, get emotional, or try to time the market. This is where index funds secretly win. Index funds force you to be consistent. They protect you from your own worst habits, and they let you grow with the market instead of trying to beat it. It's not exciting, but it works. It has worked for decades. But does that mean picking stocks is always bad? Absolutely not. Some of the richest people on the planet made their money by owning individual companies. And you might be thinking, well, if they can do it, why can't I? The answer is, you can. But you need skill, time, research, patience, and the ability to handle big losses without panicking. Most people aren't built like that. Here's something interesting. Most professional investors fail to beat the market consistently. These are people who do this for a living. They study companies all day. They have teams, software, data, and huge resources. And they still lose to simple index funds over time. So if the experts can't reliably beat the market, what are the chances that the average person can? And yet, some still do. That's what keeps the dream alive. That's what tempts people into stock picking. That small chance that they might be the one who picks the next huge winner. If you're finding this helpful so far, make sure to like this video, subscribe for more, and send this video to someone you know who's thinking about investing but doesn't know where to start. It really supports the channel. Now here's something most people overlook. You don't actually have to choose one side. You can combine both. You can make index funds the foundation of your portfolio and then use a small portion, maybe 5 to 10%, for individual stocks you believe in. This way, your long-term safety is protected, but you still get the excitement and potential upside of big winners. This approach is sometimes called core and explore. The core is the stable, dependable index fund part. The explore is the individual stock part. It gives you the best of both worlds. And most people find it way easier to stick with long-term when the risky part is kept small. Think about this for a moment. If you had to build a house, would you make the entire structure out of glass? Or would you build a strong foundation and then add nice designs on top? Index funds are your foundation. Individual stocks are the design choices. The foundation keeps everything safe. I have another question for you. If you had the chance to invest in only one stock for the next 10 years, which stock would you choose? Think about it. And tell me in the comments because I'm really curious what your number one pick would be. Now let's talk about long-term versus short-term thinking. When you hear stories about people making millions from stocks, you almost always hear about the ones who held their investment for many years. Not the ones who bought and sold every week, not the day traders, not the gamblers. Real long-term wealth rarely comes from jumping around. Index funds encourage long-term thinking. Individual stocks tempt you into short-term thinking. And sometimes that's the biggest difference between people who grow wealth and people who lose it. Another thing people forget is emotional control. When your portfolio drops 20 or 30%, index fund investors usually stay calm because they know the whole market is down. But individual stock investors panic because they start wondering if the company is dying. This emotional roller coaster pushes many people into selling at the worst possible time. So which one actually makes you rich? The honest answer is, both can. But for most people, index funds are the safer, more reliable, and more predictable path. Individual stocks offer bigger rewards but come with bigger risks. The real question isn't which one makes people rich. The real question is which one makes you more likely to stay consistent for decades. That's the question that matters. So here's my final question for you today, the one that might decide your entire strategy. If I told you that you could become wealthy for sure over the next 20 to 30 years by simply investing in index funds and never stopping, would you take that path? Or would you still chase individual stocks hoping to get rich faster? Leave your answer in the comments because I want to know how you think. And if you enjoyed this, make sure to like, subscribe, and share this video with someone who's trying to build wealth. More amazing content like this is coming your way, and I don't want you to miss it. Thanks for watching, and I'll see you in the next one.